So the main question remains, what if we go through a technical default on the US? The situation in Washington has driven trading lately, overshadowing the beginning of a busy week of earnings. Citigroup reported weaker than expected results as the bank was hit by a double-digit drop in bond trading revenue for the quarter, sending its shares down to 1.5%. Johnson & Johnson reported as well stronger than expected quarterly results on strong growth for its prescription drugs, while Coca-Cola reported revenue slightly under expectations. All to this, we need to understand that if all these companies start reporting, and both of these companies are Dow components, Intel Corp, for example, shares reversed early gains and fell 0.9% after the market closed, after it reported revenue that topped expectations. We also have the example of Yahoo, who also lost its initial post-market gains, trading flat after its results, while CSX Corp held on the slide after hour gains. Shares of Teradata Corp fell 18.4% a day after the data analytics firm cut its full-year earnings forecast. With 7% of the S&P 500 companies having reported, 52.8% have reported profits that top expectations according to the Thomson Reuters data sent to everybody, below the historical average of 63%. There have also been fewer companies beating revenue forecasts this quarter. For example, FedEx, the world's #2 package carrier, authorized a share repurchase program of up to 32 million of its outstanding shares of common stock, sending its shares up to 4.1%. On the downside, JCPenney sank 8.9% as the company's spokesperson denied a market rumor that the department store chain had hired bankruptcy counsel. The stock has fallen 63% so far this year. Data show that the pace of growth in New York State manufacturing sector slipped this month for its slowest since May, but business optimism stayed strong. So all right, there could be a technical default by missing an interest payment on US Treasuries. It has never happened in modern history, and it would be a disaster greater than the September 2008 financial crisis, in our opinion. We know that China and Japan combined own 2.4 trillion in US Treasuries, and they are understandably upset with the US about the possibility of a technical default. Most of the financial press has focused on how awful a technical default would be and who is upset, but our leaders might ask a different question. So who are the reprobates that are cheering for the possibility of this technical default in the US? Who stands to gain? Who might be happy to set off this financial bond? Let's take Citigroup, very profitable, game Eurozone sovereign bonds. Some people will play with sovereign debt just to put a few more dollars in their own pockets. In August of 2004, where it was the world's largest financial services group, Citi sold 11 billion of Eurozone government bonds in less than 2 minutes, and 30 minutes later bought back 4 billion at a lower prices to pocket a profit of 17 million. Citigroup memorialized how it could be very profitable destabilizing the market. A July 20, 2004 memo titled "Challenging the Dominance of Eurex Futures" fell into the hands of the Financial Times. Munter reported that apparently Citigroup Simon Weevil had to share this gem with his colleague Daniel Leadbetter about German sovereign bonds. When there is a liquidity imbalance, we drive up the Bund future and then hit out all the cash bids on MTS. The CEO and chairman Chuck Prince called the trades knuckle-headed. How could that be when people in the financial industry are so often called the best and the brightest? Well, today, Citigroup 2004 manipulation of the European sovereign debt seems quaint. In subsequent years, congressional testimony revealed massive fraud, suppression of bad loan data, violation of internal guidelines, persecution of whistleblowers, and reckless mismanagement at the very top levels of the bank. According to the Congressional Oversight Panel that oversees the TARP program, Citigroup received $476.2 billion in cash and guarantees from U.S. taxpayers. Citi was the top recipient of U.S. aid. Bank of America was the second with $336.1 billion, an enormous figure that was still $140 billion behind Citigroup. To be clear, and I'm not saying that Citigroup is in any way interested in shenanigans in the US debt market or credit derivatives market, but I'm only reminding you that our financial system is prone to outrageous behavior and control fraud. Our regulators, Congress, and the past and current presidential administrations have let criminals skate with little more than a rich slap. In terms of credit derivatives linked to the US debt default, in 2010, we wrote a two-part commentary for the Huffington Post. Washington must ban US credit derivatives as traders demand gold. Who would buy protection against a default by the United States? This is the main question. The answer is that anyone who can profit from House Speaker John Boehner telling George Stephanopoulos that this is the end of Sunday's morning nationally televised interview, then we know that the president, his refusal to talk, is resulting in a possible default on our debt. So what is the emphasis on all this? The House Speaker John Boehner, intentionally or otherwise, made someone a lot of money with that soundbite. The New York Times reported that he has tough ties with the lobbyists and the former herds representing financial firms, Goldman Sachs and Citigroup, among other industries. Profits on credit derivatives on the U.S. debt were shaken, confidence in all that is required. If you buy protection using credit default swaps on U.S. debt, the U.S. doesn't need to experience a technical default for you to make money. When people get nervous, the spread widens, increasing the value of the protection you bought. After Speaker Boehner's remarks, anyone who bought protection had a gain, at least on a piece of paper. However, yesterday the spread widened to around 60 BPS. For the US, that's very wide. It implies a default probability of over 5%. So let me provide some perspective. AAA rated corporate debt has a default probability of 0%. A default probability of 5% means that corporate debt is non-investment grade or junk. Sovereign debt is judged by a variety of different metrics, but it's clear that people are very spooked. So if the US actually experiences a technical default, it will be a huge windfall gain for anyone long credit default protection in the US. In other words, very, very profitable. So another question is, how large is the invisible credit default swap market in the US? Many pundits downplay the credit default swap market on US debt on the grounds that the visible market at an estimated $8 billion appears very small relative to the total credit default swap market. The size may be much larger today given that the market jitters. US banks alone holds about 14 trillion in credit derivatives, but the size doesn't have to be very large for someone to make a nice profit, right? You can play all sorts of games with sovereign credit derivatives. For example, in 2001, a couple of hedge funds thought they purchased protection against an Argentina default and sued when JP Morgan refused to pay off. But JP Morgan told a different story when it wanted to collect on the protection it bought from Daehan, a South Korean bank. JP Morgan claimed that the slightly different contract language met the definition of restructuring under a credit default protection contract it bought from Daehan. Moreover, the size of the visible market is only an estimate and the size of the visible market is unknown. You may recall that September 2008 market meltdown was due in a large part to credit derivatives and leverage. Most of those credit derivatives were invisibly embedded in other financial instruments. So you can invisibly embed credit default swaps on the US into collateralized debt obligations or CDOs and credit-linked notes. But you can also embed custom-made credit triggers into a variety of financial products. These triggers do not have to follow any sort of standard. You can make up hair triggers, so credit default swaps on the US debt are normally contracted to pay off in euros, but you can write the contract to pay off in another sovereign currency or in gold. Gold is already allowed by derivatives exchanges to satisfy collateral calls on derivatives. So let's try and follow now the money. My reason for talking about this 2010 commentary is to encourage Congress to ban credit derivatives on US debt due to the potential for abuse. Perhaps no one is abusing this situation for financial gain, but While we're asking about the horrific consequences of not raising the debt ceiling and possibly throwing the US into technical default, we should also ask who would benefit if this happens. If you follow the money, you often find someone moving levers behind the scenes. Thank you.